There's general consensus that equity markets are currently expensive. So the question is, against this background, which investment approach would be the appropriate one to follow? And I believe the investment approach better suited for the current environment is one that has a long-term bias, and one that focuses on stock selection. Put a bit differently, one that identify companies which trade at reasonable price levels and has a fair chance to be sustainable into the future. And that is the reason why I thought it would be interesting to look at the Warren Buffett way of equity investments. But let's start off with some quotes from Warren Buffett. And I'm not going to go through all of them, but I'm going to mention two. Because this gives us an idea of the type of investor we're dealing with. And the first one is, price is what you pay, value is what you get. And you will see throughout the presentation that valuations, value for money is quite critical to Warren Buffett. And the third one from the top, rule number 1, never lose money. Rule number 2, never forget rule number 1. So it gives us an idea of who we're really dealing with. Before we go through Buffett's investment principles in detail, the first one I want to address is how Buffett thinks about investments. What is his mindset? And I think this slide summarizes it reasonably well. And the first one is, think of the investment as a business, not just as some listed stock bought, for example, on the JSE. Be prepared to spend time. Unfortunately, you can't rely on investment tips. You have to study the market. Investors must have a long-term focus, and Warren Buffett suggests a 5 to 10-year investment horizon. There's no room for speculation. There's no room for short-term trading. It's a long-term game. Buy at a discount to intrinsic value. Value for money is key, and margin of safety is important. Limit the number of investments. Buy only a few investments, and Buffett suggests 5 to 10 stocks. This is a bit of a controversial point, but being Warren Buffett, we'll leave it there for now. Never leverage your portfolio. This also relates to Buffett's unease with derivatives. Before I look at the next slide, I want to draw your attention to the fact that Buffett's investment principles are not unique. A large number of fund managers, including local fund managers, are employing similar principles. For example, Old Mutual Investors Fund, and I'm quoting the Investors Monthly magazine, the fund places a lot of importance on discounted cash flow valuations to assess intrinsic value. So clearly there's emphasis on valuations, which is one of Buffett's key investment principles. Another example is the PSG Equity Fund. They refer to the 3 M's, which stand for moat, and more specifically is defined as a sustainable advantage, management with proven experience, and a margin of safety. And again, and you'll see this later on, all in line with Buffett's ideas. So let's have a look at Buffett's investment principles. What is Buffett looking for in a company before he makes an investment? And there's 4 areas that he covers. The first one is he's looking for certain business characteristics, and we'll come to the detail a bit later. The next one focuses on the management. Management must display certain qualities. Then there's certain financial decisions that the company must maintain. And the last one, market principles, is really value versus price. The next couple of slides focus on the individual principles in a bit more detail. But I think an important thing is, although the detail is important, the key is really to get a sense of the overall investment concept. So if we look at the business principles, Buffett asks 3 questions. Is the business simple and understandable? In short, the simpler the business, the easier it is to forecast cash flows. And we'll talk about cash flows a little bit later in the presentation, but the key is to understand the variables that have an impact on cash flows. And those variables are revenues, expenses, labor costs, capital allocations, so forth. The next question is really, does the business have a consistent operating history? And the reasoning behind this is, it is not unreasonable to assume that a company with a steady track record will continue to have similar results into the future, which means a seemingly boring company may not be a boring investment. Very interesting, Buffett is of the view that severe changes don't go hand in hand with exceptional returns. So Buffett is not positive about companies that faces severe changes, is solving difficult business problems, or is involved in turnaround strategies. The last one is, does the business have favorable long-term prospects? Put differently, does the business have a competitive advantage? And can that advantage continue into the future? Does the business provide a product that is desired, has no close substitute, is not regulated? Because that provides pricing flexibility. The next principle is all around management, the qualities Buffett is looking for in management. And the first one is management honest with shareholders? And that, I think, speaks for itself. The second one, does management behave in a rational manner? For example, when capital is allocated, when new business opportunities are explored. Is management emotional, rational, or ego-driven? The last one is there independent thinking, or does management just blindly follow industry peers? If we look at the financial principles, those are the financial decisions that the company needs to maintain. Buffett says, focus on return on equity, not earnings per share. And it comes back to the basic idea that shareholders need a return on its investment, a return on its equity. So identify companies that provide investors with a reasonable return on the investment. The second one, calculate owner earnings. And this is another way of saying not all earnings are equal, meaning earnings are not free cash flow. Thus, accounting earnings must be adjusted to provide you with a free cash flow number. The last one, identify companies with high margins. The higher the percentage of sales that can be converted into profits, the better. Thus, it all comes down to businesses that have a competitive advantage and those that have the ability to operate on the lower part of the cost curve. The market principles relates all to value and price. So the first question is, what is the value of the business? And very simply, it's the future cash flows discounted at an appropriate rate. So the next question is, can the business be purchased at a significant discount to its intrinsic value? Because buying at a discount is a non-negotiable for Buffett. Firstly, Buffett wants a margin of safety. Thus, if the intrinsic value of the business dips for some reason, he is, to a degree, protected from downside price risks. Another important reason is that it provides the opportunity for extraordinary stock returns in the event the stock is re-rated. So the bottom line is, to reduce risks, to increase potential upside, don't overpay. There is no doubt that the Buffett investment concept is a great model to apply. However, it's a bit easier said than done, as the individual investor does not necessarily have all the time to analyze opportunities in such detail, have the skill base, have the networks and access to information. So how can we reduce this initial workload? And in the next two slides, I will try to do exactly that, providing criteria that I find useful when scanning the market for opportunities. Obviously, we can't get away from detailed analysis, but this is a good starting point to identify companies that has those characteristics that we are looking for. In addition, the information is generally available and the calculations are not complicated. When I started the presentation, I mentioned Buffett's way of thinking about investments. And the first point mentioned is that think about the investment as a business, not just a share bought on the JSE, for example. So if that's your mindset, there's two things that stands out. Firstly, a profit history is required. And secondly, that profits needs to be backed by cash flows. So let's look at the first one. Search for companies with consistent profit history. Growth in earnings per share is a good guideline, and more specifically, companies that consistently grow earnings per share over time in excess of inflation. And earnings per share data is generally available and the calculations are simple. Secondly, the profits must be backed by cash flows. And I believe a company with a consistent dividend payment history reflects exactly that. So identify companies that trade at a reasonable dividend yield, let's call that 2 to 3.5%, and increases its dividends over time. And again, the information is available and the calculations are simple. The next hurdle is to calculate the fair price or value of the investment and compare that to the market price. As previously mentioned, the Buffett way and the preferred way is to build a discounted cash flow model. However, for individual investors, it requires a lot of time, skill, and insight into those specific businesses. So to get around this point and to reduce the amount of work, a reasonable way is to consider price-earning ratios to get a sense of valuations. And price-earnings ratios, it's historical ratios, unfortunately, but you see them in newspapers. So it's again available. Price-earnings ratio is price per share divided by the earnings per share. There's a bit of a warning. Anyone that has been involved in the market will tell you to be careful using ratios, which include PE ratios, to draw conclusions around valuations and to make investment decisions. And the warning is relevant. However, I think combined with the criteria mentioned, consistent earnings growth, consistent dividend payments, I believe it is a reasonable way to identify opportunities that might be mispriced for further analysis. Just talk about a PE for a moment. If the PE is 10 and there is no growth in future profits, it will take 10 years of cumulative profits to equal the purchase price. This already gives you an idea that if the PE is high and the earnings growth low, that the share is probably overvalued. So what is the magic number? And unfortunately, there's no magic number. But it suggests that the PE of around 20 is high. What would I be comfortable with? I'd say 8 to 15. However, the final decision obviously depends on a number of factors. The industry sector, cyclical, defensive, size of the company, the profit history, etc. The next point is to get a sense of investor sentiment. Not something Buffett mentions specifically, but Buffett says that you must ensure that the market value increases in line with the retained earnings. So if the profit increases by 20% per year, it is reasonable to expect that the share price of that company will increase by 20%. So how do you get a sense of sentiment? And there are different techniques, but I think quite a simple one is to determine where the price is trading relative to its 200 moving day average. If the share is trading above that 200-day moving average, sentiment is positive. It's generally seen as a bull market, and you can consider this the share. If it's trading below that, sentiment is clearly negative. It doesn't have momentum. And it's probably someone to leave there and wait until it actually trades above its 200-day moving average. So just to recap the criteria quickly. Consistent profit history backed by cash flows, trading at a discount to intrinsic value, and where investor sentiment is positive. By applying those criteria, I think you will end up with a much shorter list of opportunities in which you can then do detailed work, as for example suggested by Buffett. And to make this a bit more interesting, in conclusion, let's look at my investment philosophy. And I believe investments are similar to a marriage. Stick to companies with a proven track record, as the sexy young startups won't last. Thank you.